Hello and you're welcome to the Big Tech Show with me, Adrian Wackler. Now, have you ever been tempted to get into meme stocks? Have you seen or heard of others, friends, acquaintances, making lots of money or losing lots of money betting on GameStop or AMC or Bed Bath & Beyond? Or is the whole thing just a giant Ponzi scheme? Well, we're going to talk about that today. Derek Heffernan is Chief Investment Officer and Senior Portfolio Manager at Gresham House Ireland, which is an alternative asset management and investment firm. Derek, what is a meme stock?
Yeah, it's a good question, Adrian. It's kind of hard to define. I suppose a meme stock is a stock that essentially people gamble on for reasons outside of its fundamental cash flow generation. So we saw 2021, a lot of these stocks became popular because people were sitting at home, furloughed due to COVID, and they started basically betting on these stocks going up and trying to almost manipulate them upwards, despite their fundamentals on a lot of these being quite weak.
Just for the crack.
So,
examples, I named GameStop, which, as many people will remember, was a chain store that sold video games that, you know, in the age of online downloads seemed to become slightly superfluous. It is still going, though. AMC was another one. BlackBerry is one that seemed to be popular. These are all companies which we all sort of assumed were in decline because of structural weaknesses or because they had been outdone by rivals and competitors. But these then, they've a resurgence as a meme stock. Why exactly, other than just sitting at home for the crack and betting on something that they think is going to move, why did they suddenly become popular?
Yeah, it's a good question. I suppose I think you hit on the point there that the fundamentals of these companies were in deterioration. These were effectively melting ice cubes. So they were heavily shorted by the hedge funds, meaning that a lot of the hedge funds were betting on these stocks going down because you could see the fundamental decline in people going in and buying video games.
Yeah.
And you can download it at home at the click of a button. So I think it was almost these guys who were betting on these meme stocks. They saw a chance to maybe have a go at Wall Street, give it to the man, do some damage to some hedge funds, and make a bit of money and have some fun on the way. It almost became a movement.
There's a lot to get into there. I think let's just explain to people who aren't familiar with how these things work, what exactly short selling is. So you sort of summarized it there. So this, I believe, is when an investor, and let's say the investor is known as the short seller, what they do effectively is they borrow shares, don't they? And then they sell them in the hope that they'll be able to buy them back later at a lower price.
Exactly. So if you just use a company that you believe is faltering, you think fundamentals are going to deteriorate faster than the market believes.
So let's say it was BlackBerry.
Exactly.
And I was the short seller.
Yeah.
I would be borrowing, quote unquote, legally borrowing a BlackBerry share. I would then resell it immediately to you, if you being the market who's willing to buy it. I think it's going to go down by 10%. Yep. I'm legally obliged to then buy it back at some point.
Yeah.
Let's say at that lower than 10%, and then I have made money.
And then you've made your money. Yeah. So it's a dangerous occupation. Short selling. I'm a boring long only manager, so I don't have to worry about it. But they do form a very important part of the markets. If I kind of look at the benefits of having short sellers, I know they're criticised a lot, but they do tend to sniff out a lot of frauds in companies. So they do look through accounts. They do forensic accounting, and if they see something untoward, they're happy to sell the stock in the market, knowing that they can buy it back at a later date at a much lower price.
Yeah, it's an interesting way of putting it. We might come back to that in a moment. Who is Roaring Kitty?
Roaring Kitty is a man named Keith Gill. He also went on a different name on Reddit, which isn't. We're before the watershed, so it's an
F, three-star
It's
word.
an F word, yeah. Essentially, he was. I think he worked in an insurance company previous to this in marketing. He's just a normal mid-30s guy from the northeast of the US, and he became popular during 2021 for doing analysis on GameStop. And I suppose even though his initial thesis on GameStop didn't play out, he made a lot of money. I suppose his initial thesis was that the online penetration wouldn't be as severe as most people
Of
thought.
GameStop, yeah.
Of games, yeah.
So it's worth, at this point, just going into a little bit of the background of what happened with this guy, Roaring Kitty, a.k.a. Keith Gill,
Yep.
and GameStop, and how that triggered so much of the chaos and the publicity that we associate now with meme stocks. I'll give us a short potted history here. So you summarized nicely. But this guy, at the start of 2021, he got into GameStop in a significant way. Now, at this point, GameStop was trading at less than $5 a share. So this guy, Roaring Kitty, releases a video, among other information, reveals that the sort of celebrity investor Michael Berry, the guy from The Big Short, played by Christian Bale, had bought some GameStop stock. And he makes this video saying that GameStop is undervalued. And a bunch of people on Reddit in particular jump on this video. For whatever reason, they like what he's saying and they go in and they start buying GameStop. Now, the problem with that is that an awful lot of what we've described as short sellers, institutions, have bet against GameStop. They all have positions betting that GameStop is going to be going down. So when all of these kind of online internet yahoos start buying the stock, the stock price goes up, and some of these institutions are now starting to lose significant money. They then have to buy GameStop at a higher price, which again pushes the price up. And in fact, at its height, it goes from $5 a share to $483 a share, leading to significant financial difficulties, for some, for some institutions. In fact, one or two of them, I think, went bust, didn't they?
Yeah, Melvin Capital was the kind of the big victim of this. I think there was kind of a few more kind of just points on what happened and why it kind of spiraled out of control. I think first of all, companies like Melvin Capital, obviously their risk management was very poor. They weren't able to buy back. Their positions were too big. They weren't able to buy back the stock that they had borrowed to short sell. I suppose the second kind of difference on this short squeeze versus we saw a Volkswagen short squeeze about 15 years ago, but the big difference here was the use of short dated options. So essentially, option is an option to buy something at a later date or an option to sell something at a later date. And I think that makes you actually have to put very little money down to make a sizable impact. And when you buy an option off your counterparty, they have to go into the market and hedge their risk on the other side. So
Right.
there's so much reflexivity in this thing that small little moves can just be magnified, and that's exactly what happened. What traditionally should have been a ripple became a tidal wave very quickly.
So, and there's lots of things about this GameStop trading. And it wasn't just GameStop, it then expanded into other stocks. We've mentioned some of them, AMC, Bed Bath & Beyond, Nokia, many others like that. But why did those Redditors, did they go into this stock? So obviously some of them wanted to make money, but there was definitely a hint or a sense that some of them wanted to do it to stick it to the man, that this was an online movement, that they were going to exult in the demise of stuffy, white-shirted investment firms, Wall Street, who they're completely sick of.
That was exactly it. It became a movement, and for a lot of these people, the money didn't seem to matter. It became a way. Let's get Wall Street. These evil short sellers are a blight on society. Let's get them and let's make an impact. But I suppose at the end of the day, when kind of all the dust has settled, and now I know we can go back to it, it's kind of started up a small bit again, but when the dust has settled, there was a few victims on Wall Street, but there was a lot of people that made a lot of money on Wall Street from this. Wall Street loves activity. Wall Street loves volatility. And that's what came about from this. I suppose the other kind of where I date the start of this whole meme stock phenomenon is 2019, actually pre-COVID, and the introduction of commission-free trading and the Robinhoods of this world.
So Robinhood is a good example, because for people who don't know it, Robinhood is one of the most popular apps that you can download for your phone and trade shares on, and a lot of people use it. But at one point during the GameStop episode, they actually stopped trading, didn't they, on their platform? And why did they do that? And did that cause a reaction among Redditors and online people saying the whole thing is rigged?
It did. They did stop trading. If I look at that episode, and I kind of, there's a lot of conspiracy theories online about that. I actually think it was a positive, and I think it saved a lot of people a lot of money.
The fact that they stopped
stopped trading. Now, there's a hell of a lot wrong with Reddit or with Robinhood, in my view. If you open it up, it effectively it's so gameized. It looks like Paddy Power, and you have the most highest trending stocks. I suppose, why does a real investor with a long term? Exactly, it's exciting.
It's meant to look sparkly and all the rest of it. But I guess by halting trading, what they were doing really was protecting existing, more institutional traders. And probably the argument that the Redditors and the internet people would have made is, well, why are you doing that? I mean, the practice of short selling is so risky itself. And we have shone a light on the absurdity, in a way, of the system. So why are you protecting all these, Harvard, Yale, New York, Wall Street types?
Yeah.
When you wouldn't save us if we were going bust?
No, it's a very good question, and to be honest, I still haven't gotten to the bottom of why trading was halted. They will argue that it was halted to protect the retail customer buying a call at ridiculous valuations, and then the other side, the retail investor will argue that you're just trying to save the other side of it. Exactly.
Yeah.
So, I suppose it's a debate that will never be solved, and even 3 years later, on Wall Street Bets on Reddit, it's still going on.
So where are we now? Because in recent weeks we have seen the same guy, Roaring Kitty, Keith Gill. He has recently disclosed that he has increased his position in GameStop. He's buying more, and this has led to speculation about whether we're in for another mad roller coaster run, and whether it will expand into other stocks. Where are we at right now?
Yeah, I suppose I don't like making forecasts, Adrian, because I'm always wrong. But I suppose my view on it, the conditions that were there in 2021 just aren't there now.
What do you mean?
You had people sitting at home with loads of money. The furlough in the US was so generous, loads of cash in their pocket. I suppose sports betting had just come to the US, and they were kind of that was already taking off, and then sports were cancelled. So you had loads of money, people sitting at home with nothing to do, interest rates at 0%. So you had those three preconditions that just aren't there now. People are back at work, interest rates are above 5%, and savings rates have come down significantly. So that liquidity that drove the first meme stock part one, we'll call it, just isn't there anymore. And I just don't see this coming back. I kind of view this as almost like an echo bubble that people who are maybe a bit annoyed it didn't make cash on it the first time are coming into it. But yeah, I think hopefully we can consign this to history in a few months, and this will roll over again.
Yeah, there's a great scene from the original movie Wall Street, the 1987 movie Wall Street, where Charlie Sheen's character Bud Fox is being lectured by the actor Hal Holbrook. I can't remember what his character's name was in the movie, but the Hal Holbrook figure is telling Charlie Sheen, look, stop with all of your fly-by-night schemes. You need to look at the fundamentals of a company. You need to look at, where is it going? Does it have a good product? Does it have growth prospects? But all of that flies out the window with meme stocks, doesn't it?
Exactly. Look, my business is trying to make my clients rich, but we're trying to make our clients rich slowly. We're trying to protect their incomes against inflation, protect their pensions. Getting rich slowly is boring, but it's effective. It works. Buying companies that you can pay decent dividends, are supported by strong free cash flows, have strong balance sheets. It is very.
Yeah, I mean, I looked at GameStop's most recent quarterlies, and I think it had a quarterly revenue of $881 million, but it lost $32 million. It has a market cap of $9 billion.
Yeah,
it's still very, very highly valued comparatively. Yeah. And if I'm honest, I'm not expecting to see GameStops start, popping up around the place in retail centres in Ireland anyway. And I've just been to the US. I spent 2 weeks in the US. I didn't see a single GameStop there either. So I guess, if you are to look at a company's fundamentals and not a cryptocurrency style craze, because there is quite a parallel here to crypto, isn't
there is. I think you hit the nail on the head there. GameStop. No new GameStops are opening up. It's like saying Extravisions are going to turn a corner and start coming back. It's gone. It's dead. This is a melting ice cube, and management have shown zero plans for that not to be the case. Now every stock has a price, but as you say, I think if GameStop was trading 80% lower today, it still doesn't interest me, and I think that's how little value there is in the thing.
Just finally, what are the protections that might be there for you and I and others that that you're down the pub, you're listening to somebody who claims he's just made 500 quid trading GameStop. Obviously, we've spoken about Robinhood stepping in to protect investors at a certain point. But is there any meaningful protection against GameStops, against meme stocks?
There's nothing harder than seeing your neighbour get rich, is there? There's no more powerful driver than the fear of missing out. But I think if you just have a credible plan, have your pension contribution, put it at some credible strategy that has worked over history, I think you'll be fine. And it's almost a lot of this is trying to block out the noise and ignore what's going around you. I think. Look, I remember going down. I think we've all seen the Bitcoin mania, and everyone from school managed to get rich from it. So
some people have gotten rich off Bitcoin. And to be fair, as a medium-term to long-term investment, Bitcoin hasn't been a bad investment.
It hasn't. I still look. I'm a skeptic of that universe because I like to look at tangible. I like to look at margins and cash flows before I value something. I do agree Bitcoin is different to these meme stocks where I can actually see the tangibles in these meme stocks, and I can very easily.
The difference between Bitcoin and a meme stock, to me, like between AMC, GameStop, and Bitcoin, is there are a lot of people who argue that Bitcoin has fundamental value, and there are enough people who argue that it has value to actually give it value.
Yeah.
Whereas with GameStop and AMC and BlackBerry and Bed Bath & Beyond, you really get the sense that people are only committed to this for 5 minutes if it can make them 10%. They don't fundamentally believe in the underlying strength of the brand. Although, to be fair, Roaring Kitty, Keith Gill, says he does.
Yep. Yeah, and I in a way I do believe him. He has stuck to this mantra. Now, as I said, his investment thesis has been wrong, but he's made a lot of money. And I think, look, the most important thing is the way we view anything is if you buy something, you have to be prepared to hold this for 5 to 7 years, and you own those cash flows. The investment style of needing a bigger fool to come in and buy what you own, it's a risky business because someday that fool won't arrive and you'll be caught holding the bag.
Well, I guess that is the business model. There will always be fools. But anyway, Derek Heffernan, Chief Investment Officer and Senior Portfolio Manager at Gresham House, Ireland. Thank you very much for joining us on the podcast today. Stephen O'Brien was on sound on this podcast and JJ Clark produced. I'm Adrian Weckler. You've been listening to and watching The Big Tech Show, and we'll talk to you soon.